Ladies and gentlemen, good day. You are highly welcome to this session, which is being organized by the Dicalo Consulting Group to discuss about the importance of good corporate governance to an organization. My name is Mr. Akam Dixon, and I am a fellow chartered accountant with more than 10 or 12 years of experience across the Middle East and Africa, exposure in corporate governance, in managing multinationals, SMEs, as well as startups. So, in this session, I'll be joined by my very good friend, Mr. Aaron Munga, who is the CEO or the Chief Executive Officer of the Switcher Group. Switcher is a fintech company, and he has co-founded so many companies over the years, and is working on a series of projects. He has a lot of exposure, a lot of practical experience on the application of the principles of good corporate governance. And with experience of having worked over more than 10 years and having started and run several startups, we want him to share his experience, his exposure, and the implications as well as the benefits of a company adhering to the principles of good corporate governance. So, in the meantime, I'll be giving the floor to Mr. Aramunga to introduce himself and then give us a highlight of what corporate governance is all about. And then from there, we're going to dive straight to discuss on the principles of good corporate governance. We're equally going to be looking at the approaches to corporate governance, and then we're going to be looking at the various committees that the company can put in place in order to fully adhere and enjoy the principles of corporate governance. And then at the end of the session, we're going to dive to look at the board structure, how the board of the company should be composed, and the principles that the company can equally put in place to ensure that they have a good board of directors. So over to you, Mr. Eromunga.
Yes, thank you so much, Mr. Dixon Akam. I'm really super grateful to be on your platform again. It's always a pleasure to be on the Dicalo Consulting platform. I think this is the third time or so that I've been on the platform, and the fact that I keep coming back or keep wanting to come back is a testament to the quality of the conversations that we always have each time I have an opportunity to be on this platform. It's always a give and take, where I share my experience, my 2 cents on different subjects, and I also get to learn, from other participants and from members of the Ticalo Consulting team. So thank you once more for bringing me on. You already did the introductions. My name is Aaron Munga. I'm an entrepreneur, founder, and CEO of Switcher. Switcher, which is a fintech that we have created a mobile wallet, a kind of global mobile wallet that provides borderless cross-border financial services and digital products to people across the globe, but especially across emerging markets. We also have a B2B element to our business under the umbrella of Switcher Connect, wherein we build software solutions that powers SMEs. We help SMEs and other fintechs to deliver services to their own end customers. So that's what we do at Switcher. Now, talking about corporate governance, you mentioned I should say something about corporate governance. Yeah. So as far as corporate governance is concerned, what I understand by corporate governance is simply a framework by which corporations are managed and governed for the betterment of all stakeholders involved. That's corporate governance from a very practical perspective. That's corporate governance in a nutshell. It's simply a framework or a process or a system that you put in place to ensure that a corporation or an organization, when we say corporation, people think maybe corporate governance is only limited to commercial companies or private companies. It's simply a framework wherein organizations are managed in the best interest of every stakeholder involved. So that's the way I would summarize corporate governance in a nutshell.
Okay, that's a very good intro, Mr. Aaron Munga. Okay, and again, like he has explained, corporate governance in essence is simply a set of rules and principles that have been put in place to help and ensure that companies are well governed. Again, like we have explained here, we're going to understand that the wider view of corporate governance is going to be that the company is not going to be governed only in the interest of the shareholders, but rather in the interest of all stakeholders. So, Mr. Aaron, being a very important guest, and given that this conversation is going to be some sort of a panel conversation, can you please explain the two approaches to corporate governance before we go to the importance of putting in place a good principles of good corporate governance? So, what are the main approaches, the leading approaches to corporate governance globally? Can you talk more about that?
Sorry, my network was a shaky. Can you please repeat the question?
Yeah, I was like, okay, we understand that there are two leading approaches to corporate governance, which is the Combined Code and the Sarbanes-Oxley Act. Can you throw a little bit of light on the requirements of the Combined Code, which is the approach to corporate governance in the UK, and the Sarbanes-Oxley Act, which is the approach to corporate governance in the US? Can you give a throw light on the importance of each of these approaches and what makes them different from each other?
Okay, so I think it's the way I would look at it is I will categorize things into two main classes instead of going into details. I mean, on the theory into the theoretical part of these corporate governance approaches. I will just explain, like, in the US, there is more demand for an independent board, you know, compared to in the UK, wherein, I mean, there is also a need for independence, but then there is not a clear-cut rule which states that directors have to be completely independent from the company. So you will have probably the non-executive directors and the executive directors sitting together, you know, in a combined board and making decisions in the interest of the company. On the other hand, where, I mean, in the US, we know the history of the likes of Enron and so on and so forth. Uh, and that led to the Sarbanes-Oxley Act, which basically seeks to ensure independence on the part of the directors by looking at the approach where you have two separate committees, where the supervisory board is completely different from the executive board, rather than the approach where I just described, wherein you have the net and the head sitting together in one board and making decisions in the interest of the company. That's my understanding, at least, of what the major differences between the combined and the more of independent board in the US.
I think that's a very good explanation. Again, I want all you to understand that at the level of the US, they have what called the Sarbanes-Oxley Act, and the Sarbanes-Oxley Act was actually enacted after the collapse of corporate companies in the US, like Enron, which actually were performing very well at the period when they actually published their financials, but within a short period of time, they realized that the companies actually collapsed. So basically, the approach to US is more stringent, which is a rule-based approach, which means at the level of the Sarbanes-Oxley Act, which is the approach to corporate governance in the US, it is a legal requirement, it is mandatory, it is compulsory that all companies should adhere to the requirements of corporate governance. However, at the level of the combined code, which is the approach to the US to the UK, companies can either adhere to the requirements of corporate governance or explain the reasons why they could not adhere to the requirements of corporate governance. And again, like we have said, this is a very practical approach. And in this situation, we want to be looking at our exposure and our experience in the corporate world. So, from based on this, a company should be able to know whether depending on the nature of the operation and depending on the philosophy of senior management, they should be able to decide which of the approaches to corporate governance that they can actually implement within the organization, given that especially for companies that are not in the UK or that are not in the US, it's not going to be a legal requirement for them. It's not going to be compulsory, but because of the fact that they want to apply best practice, they want their company to be well governed in such a way that the company is going to be seen to be fair, and that will attract and protect the interests of all stakeholders. It means that they may then decide on whether they can adopt the approach to the US, which is the Sarbanes-Oxley Act, or the combined code approach, which is the corporate governance approach to the US to the UK companies. So again, let us look at. Can you give a throw out on how you would recommend how the importance of the board of a company, because you understand that there are so many startups, especially in Africa and the Middle East, where they raise a lot of funds, But within a short period of time, the US realized that these companies always collapse. Can we say that some of the reasons why most of these companies are collapsing after having raised a lot of funds, maybe within a year or two, is it because of the fact that they have some issues at the level of their corporate governance? Again, can you also talk on why more? Is it because most of them also don't have board of directors? And I'll be glad to hear from you on how you think that the board of the company should be composed of.
Okay. Thank you, Mr. Akam. There are quite a few parts to your question, so I will
Yeah.
try to break them down. So, let me start with companies, startups that raise funds and collapse. Again, I just want to point out that this is not a phenomenon only in Africa, it happens everywhere. In fact, the biggest profile collapses
Yeah.
are outside of Africa. So, a good example that I want to touch
You're
on
right.
that I personally think, based on publicly available information that I've gone through, I personally think that it had a lot to do with corporate governance, is FTX. So FTX crashed, and I think the founder and CEO was some sort of the god of the organization. There was no clear corporate governance framework. There was no board, and his authorities was left unchecked. And in such a situation, either because of maybe incompetence, it can be incompetence sometimes, it can be dishonesty. And I'm not pointing to any I'm not accusing Sam Bankman Fried of any of this, but I'm just saying, when a founder, just talking about corporate governance, when a founder or a CEO has the sole power to make decisions and no board to some sort of check and balance, act as a check and balance um, for the executives, then there is a high likelihood that things could go wrong. Because sometimes people could just not have the experience. They could make mistakes that could have been identified and discussed at the level of the board. They might be lacking valuable input from experienced board members, because you don't just call any kind of person to become a board member, right? You look for people with specific skills and experience, specific skill sets and experience in that field or in business as a whole. So having a good or a high quality board actually helps to check the executives under the leadership of the CEO, brings much valuable input from what we expect to be more experienced um, stakeholders into, to bear on the board and provide valuable input for decision making. So FTX and Bankman Fitch is a very good example where I feel like, or where I personally believe, this is my personal opinion, that corporate governance would have made a difference. I'm not saying that corporate governance alone would have saved the company. Having good corporate governance framework would have saved the company, but I think it would have made a big difference. And yes, a lot of other startups that fail, there could be so many reasons. There's just so many. The list is endless why startups fail. But having a good corporate governance framework is important for every company. Whether a startup, whether a more established company, having a good corporate governance framework is very important. It's important when a company is small, but even more important when a company starts to scale, because then at that point, the cost of any mistake, or the cost of taking a wrong decision, or the cost of not complying, becomes really high. And becomes a real burden to the company. So at every stage, corporate governance is important, but as the company grows, it becomes more and more important. Especially, I'm taking this approach. I'm trying to stick to the very practical aspects of this, because corporate governance also is a kind of cost to the company. So, like, for example, uh, having a chairman that is not also the CEO is a good recommendation of corporate governance. But as a small company, you might not be able to afford an external party to be the chairman, so you might have the CEO being the chairman. So as a small company, you might not be able to comply with almost every aspect or the recommendation of corporate governance. But as you grow and have the resources and the bandwidth, and also it becomes super important, then you have to try as much as possible to move closer and closer to what we would refer to as corporate governance best practice. Now, touching on the other angle of your question, right? Like what I recommend. I think from my explanation, you can already see my thought process or my 2 cents on this. When a company is still small, you could have a very simple, as a startup, you could have a very simple structure The most important thing is there should be some sort of check and balance on the executive power. That's what I try to do at my startups as well. Like at Switcher, I'm the founder and CEO. However, we have a board. We have a board that is comprised of two external, like myself and some executives in the company, and then we have two external non-executive directors who have extensive experience in banking and business and so on. And those two nets act like a kind of check and balance to our decisions. So they have to be okay and approve major decisions like maybe fundraising targets, application of funds, executive benefits, and so on. And of course, there are so many other recommendations. Like for me, as an accountant, before being an entrepreneur, I understand the importance of corporate governance, and I try as much as possible to ensure that we are complying, to the best of to the best extent of our resources. For example, I'm not the chairman of Switcher. I could be, and it would be reasonable because the company is not big enough, but still, I prefer to have a non-executive director become the chairman so that there is that check and balance to make sure we are not tilting the company to the wrong direction and that we are benefiting from the input of this very experienced business practitioners who have been in business longer than us and can see can see through some of the loopholes, can see through some of the mistakes, can guide us and make sure that we are staying the course on the right path. So that's basically what I think. As a small company, do what you can, but just ensure that there is a balance, because this is what corporate governance is all about. There is a balance, and that executive power is checked. There is that external input, and as you grow, you can now start looking at putting in place some of the committees. Making sure that, okay, if you're appointing an external auditor, there is an audit committee. That the auditor will liaise with, and so on and so forth. As you grow and as you can afford some of those things, then you start, implementing some of those best practice recommendations. So to summarize this, my recommendation is, if you are not a company based in the US, even if you are based in the US and small, I will stick with the comply or explain approach. And then as you grow, and especially if you have ambitions of listing in the US stock exchange market, in the US capital market, then you should move closer and closer to the Sarbanes-Oxley approach to corporate governance. This is my recommendation.
Okay. I think that's a very, very good explanation. Again, to our audience, you must understand that the CEO of Sutra, or founder of Sutra, has emphasized two issues here. Again, he's saying that at the level of the board of the company, we should have two categories of individuals. Normally, the board is headed by the chairman, but in addition, we should have two sets of people in the board of the company, where we have the executive directors, which are actually headed by the CEO, and the non-executive director. Again, the importance of corporate governance here, it's actually mostly applicable to all organizations, but most importantly to companies where there's separation of ownership from control. Again, we are saying that if we take an example of a small company where maybe it is a one-man business, and they have limited resources, it's possible that it will be difficult for the company to fully comply on the requirements of corporate governance. But again, we have realized that just the fact that the company is complying to the requirements of best practice of corporate governance, it goes a long way to project the image of company in a positive manner. Especially, let's take an example of startups who want to raise funding. And again, you have a startup where they want to raise funding, but you realize that they don't have any structure. They don't have any structure in the sense that everything rotates around the founder or founders. They don't have any finance team. They don't have any non-executive directors. They don't have any board. They don't. Maybe the company is maybe not registered, or they don't comply with any rules and regulations or things like that. Then automatically you see that investors, for sure, will not be interested in that startup. Why? Because they think that the company is not well structured. Since the company is not well structured, there's no reason why investors should trust in investing their funds in this type of organization. So we're encouraging the fact that even though you're a startup, even though you're an SME, even though you have limited resources, it is been of good value, it would add more value to your company if you try to put in place a good board of directors where you have both executive and non-executive directors. And like I've explained, the executive directors will be headed by the CEO, and they will be responsible for managing the day-to-day operations of the company, while the non-executive directors that are actually led by the chairman, who also leads the overall board, should be overseeing all the decisions that are made by the executive directors to make sure that they are in the interest of the company. For sure, we understand that there are several reasons why we have this mixture of both executive and non-executive directors. Well, because we understand that non-executive directors are not the employees of the company, and as such, don't have any personal interest as opposed to the executive directors, who in most cases they are employees in the company. And given that in most cases they are employees of the company, there are always that conflict of interest between the owners of the business or the shareholders and the executive directors. The more reason why the corporate governance is recommending that we should have a set of non-independent directors where they don't actually take part in the day-to-day operations, but their sole role will be to oversee all the decisions that have been taken by the executive directors, to make sure that at the end of the day, the interests of the shareholders, and like we have explained, not only the shareholders, to ensure that the interests of all stakeholders are being protected. Again, the CEO of Sutra, Mr. Aaron, I want you to throw a light, because there are cases where there are quite a lot of pay parity, where you see the same employees earning this, doing the same job, or with the same qualification, with the same level of experience, but you realize that these companies are paying different salaries. Maybe let's assume employees have the same capabilities, they have the same competencies, they have the same level of experience, as well as they have the same education or maybe family responsibilities. We realize that there's A, which is earning maybe 20% more than employee B. What will you think? Will you recommend that this company should have a remuneration committee? And what do you think this committee, what benefit do you think this committee will bring to this organization? Or what do you think the company can do as principles of good corporate governance that will help them to avoid that situation where employees are paid proportionally more than their peers, whereas they do the same work?
Yeah, so thank you very much for that question and for bringing up this subject. So from the very beginning, and from a very practical approach, I did mention the fact that corporate governance is not just about the owners of the company, it's not just about the managers of the company, it's about every other stakeholder. So and that's where corporate governance really comes in, because without a good corporate governance framework, situations like what you just explained would happen. And uh, I mean, we can go into every other aspect of the company. There will be a lot of unacceptable things happening, you know. So again, we have to be very practical. When a company is small, uh, it might not be possible to um, like stick strictly to the recommendations of corporate governance best practice. However, understanding what the best practice recommendations seek to achieve, you can still, even as an SME, as a startup, have some semblance of good corporate governance principles and practices within your company. For example, I understand that when a company grows and has like let's say hundreds or thousands of employees, then it's very important to ensure that you because corporate governance is about fairness. The scenario you described is very unfair. You know, if we have two employees, employee B and employee A and employee B, who contribute equally to the company, because companies, we pay employees. I mean, from an employer's perspective, employees should be compensated based on their contribution. So if you have two employees who are equally contributing, who are equally, I mean, who are both very skilled and are able to deliver to the company's expectations, there is really, I mean, it's very unfair to have, this is my opinion, it's unfair to have employee A earning significantly more than employee B without an explanation. If there is a good explanation, for example, employee A has been in the company for X amount of time and there is seniority bonus and things like that, and this is clearly documented in the company's policies, because again, it's about fairness. People need to know the rules that they are being managed by. Because if you're just, how can I put it? You're just doing things without clear policies, and these policies are not communicated to employees. Even when you're being fair, employees can perceive you as being unfair as an employer. So even without a remuneration committee, which is what would be recommended in big companies, where the remuneration committee will specifically ensure. One of the main functions of the remuneration committee is not even to look at salaries of every employee. It's really about balancing executive contribution to the company, their compensation, and to ensure that the interests of the real owners of the company, the real owners of the companies are being protected. The shareholders are being protected when it comes to compensation and bonuses for directors. However, that same principle should be triggered down the organization, wherein people are compensated based on their contribution to the company rather than based on other criteria. Like, for example, sometimes it might be based on your nationality. Sometimes it might be based on the relationships that you have in the company. That is always unfair. And companies who do that always tend to lose quality employees, because I could be very happy that, okay, I'm earning X amount, but the day I know my peer is earning 30, 40%, 50% above what I'm earning, even though we are equally contributing to the company, I might stay as long as I don't have any other role, but I will be dissatisfied, and I will feel like the company is unfair to me, and I will be, constantly looking for, another role. And this is costly to the company in the long term, because there's a lot of tacit knowledge that employees have. You might have things documented and so on, but if someone has been in the company for long, and they've built relationships, depending on the role though, they've built relationships, they understand the processes, they can help to train new employees. When you lose such an employee, you've lost an asset. And that is just a failure of corporate governance, because if you understand corporate governance and understand that it's in the interest of every stakeholder, then you will want to be fair to the most important part of your company, which is your employees.
Okay. I think that's very, very good recommendation. Again, like he has explained, the role of a remuneration committee is very, very important to every organization. And he has explained, in most cases, the role of the remuneration committee is to focus on the setting the pay of both the negative of both the executive and non-executive director. But he has recommended that that should be trickled down to the entire organization, where it should move down to departmental heads, to directors, as well as to the bottom line employees within the company. Again, I want to have this to say. What would you say? Let's look at an organization where they practice what we call discretionary management. Discretionary management, in the sense that this company does not have any basis on promotion of employees, or a company which does not have any basis on how the salaries of employees should be increased, or does not have the basis on which bonuses should be awarded to employees within the organization. Will you say such an organization will you say such an organization where at the discretion of so let's look at the situation where this company, they actually practice more of discretionary management. I've explained that in this situation, it is at the discretion of a manager or at the end of the year to determine whether an employee should be subject to a promotion, should be subject to a salary increment, or should be subject to a bonus that is being granted by the company. Will you say such an organization is adhering to the principles of fairness, or which is a very, very important principles of good corporate governance? What would be your advice to such an organization?
Yeah, so I think discretionary management is actually the result of a failed corporate governance regime, because corporate governance actually is in place more, so to speak, to actually discourage this kind of management style. Because if a company adopts a discretionary management style, then obviously it's hard for that company to be fair, because again, it's discretionary simply means it's at the discretion of individuals. It depends on how they feel at a particular point in time. So that approach is actually a good example of what will be obtainable in a failed corporate governance regime. So I wouldn't recommend that. It's very important that companies should have clear-cut policies on how things are done, be it promotion, be it bonuses, be it salary increments, and so on and so forth. Not only that these policies should be put in place and approved at the board level, because again, corporate governance, if the board has to set the tone for corporate governance. So when things like this are approved at the board level, then managers will also take it seriously and they will understand that there are repercussions for not complying. Like there is clear repercussion for non-compliance to these principles. And these policies, principles, rules, or whatever you want to call it, should be in place, approved, and should be properly communicated. It should be available for employees to consult. For example, I should be able to I should be able to review the HR policy and be clear on how my bonuses will be calculated. It means I know the rules by which I'm being judged. So during the year, as I'm working, I'm measuring myself up against those rules, such that I could even have a very clear idea of what my bonus will be, and that can help me to plan. When you have those kind of policies and you have that kind of culture in operations, then you actually will be able to retain employees, good employees long term. Because organizations, depending on the industry, but it's true for every organization, your employees are the most important part of the company. Without competent people, the company will not work. It's like if you keep employees happy, they will keep the customers happy. And if the customers are happy, the company will be happy, the shareholders will be happy. That's the way I actually, that's the roadmap I follow. If the employees are happy, they will do everything to make the customers happy. And employees will not be entirely happy if you're not fair. It's all about fairness. And the only way you can be fair is by having clear-cut rules that are transparent and available for everybody to review. And then those rules are strictly applied. There should be zero tolerance for non-compliance with the policies, and the board has to ensure this. So the example you described, where in a company the manager just takes a decision based, that's like a failed corporate governance regime. And if such a company, or if companies that operate in such a manner don't take this thing seriously, then it's like a worm, or it's like a virus, and it will grow. And one day, the cost of not having a good corporate governance regime will not only affect employees who are not being treated fairly, but will affect the whole structure. Because it's like if people do things and they are not checked and there are no policies, then one day people can someone could make a mistake and it will cost the company a lot, just because there are no clear-cut principles and rules on how these things should be done, and there are not clear repercussions for non-compliance.
Okay, that's a very, 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 very important point which I've actually raised. Again, the topic of our main heading for today was to focus on looking at the importance of good corporate governance, principles of good corporate governance, and we have already discussed a series of them here, which we have just discussed about fairness now. And what would you say would be the role of transparency? Because you understand that corporate governance simply means that the company should be simply a set of rules or procedures, how a company should be well governed. And again, we have explained that the govern here should not only be in the interest of the owners of the company, but rather it should be the interest of all the stakeholders. Now, when we talk about stakeholders, I want the audience to understand that stakeholders in this situation simply means anybody who can affect or can intend be affected by the activities of the company automatically becomes what? A stakeholder. So let's take an example for, say, company A. If Fintech company which is operating, say, in Cameroon, like Switcher, they have their shareholders, which are, let us try to identify some of the stakeholders of Switcher in Cameroon. We understand that the shareholders of Switcher, which is a fintech company with global operations, automatically are one of the stakeholders. We have the government, which means that Switcher has to pay taxes to the government. So automatically the government becomes what? One of the stakeholder, which in this situation is like an external stakeholder. We equally have employees of Switcher. if Sucha does not pay salaries, it's going to affect the lives of the employees. Automatically, employees become a stakeholder. We have financial institutions, we have customers, we have third parties. Maybe the companies that are helping to host their apps or to host their platforms or things like that. Automatically, anybody that can be affected or intend to be affected by the operations of the company is a stakeholder. The more reason why we are saying that the modern view on corporate governance is that the company should not be only thinking of how they can govern the company in the interest of the shareholders or in the interest of the employees, but rather it should be putting in place policies and procedures that will make sure that all the stakeholders, that the interest of all the stakeholders is properly protected. So at the level of transparency, it means that if the company is supposed to pay, say, their taxes, they should be able to prepare and present financial statements following the relevant reporting framework and making sure that everything about the disclose and prepare and present the financial statement that show a true and fair view. They should not be trying to present a view that will enable them to pay less taxes. Because if they try to engage into activities that will let them to pay less taxes or not to declare all their revenue or to overstay their costs, it means that in this situation they're not going to be transparent. And if such an organization is practicing such an activity, it means that the company is already falling short of one of the requirements of what? Good corporate governance, which requires that the company should be what? Transparent in all their business dealings with their stakeholders. So I'll be happy that Mr. Aaron, you talk more on how independence being one of the principles of good corporate governance. How do you think, or what do you think a company should do? Again, we have already discussed this at the level of the board structure. So again, I want you, do you think that with your exposure, with your previous experience working in the corporate world, do you think that internal auditors are truly independent the way we know or think?
Okay, so I think there are two parts to that. So I'm going to touch on the two parts. The first part is about fairness. I think we've talked about that for a while, so I will not belabor the points. I will just
Yeah.
summarize by saying that you cannot have fairness without transparency, because even if you're fair and you're not transparent, some people might not be able to assess whether you're fair or not. So you have to be transparent
Yeah.
so that people can make their own assessment on whether you're fair in your dealings. So I think transparency is super important. We've touched on independence as well, why directors, non-executive directors should be part of the board and so on. Now, let's talk about now going, I think that's how you got to the internal committee part, because it's a big debate.
Internal audit.
Yes, it's a big debate on whether internal auditors are actually independent. Okay, let me put it this way. Ideally, in order for internal auditors to be able to perform their duties and you know deliver on the promise on why we create why we put in place internal auditors or an internal audit department, they need to be independent. Because when they are independent, actually easy for them to do their job. However, there is a big limitation, because in most cases, internal auditors are employees of the company. Then it becomes very difficult, practically speaking. Theoretically, you can say, yes, they are independent, and so on and so forth. However, you and I, we are professionals, and we understand that in practice, it's very difficult for internal auditors to be able to achieve that independence, as in most cases, they are employees of the companies that they work for, right? So they have colleagues. They are basically checking the work and activities of their colleagues. They could have personal relationships with people in the company. There is also familiarity. If you have been, for example, if Dixon is the CFO and I'm the internal auditor and I've been checking his work for 5-6 years, there is that familiarity track that I might just overlook certain things because I trust that he will get things done the right way. But that just could be the year or the month where things didn't go well. So in practice, it's very difficult. However, there are recommendations. I have a few recommendations that I could make on how we can improve, because again, corporate governance is not perfect, right? So one of the limitations when we look at the fact that we need to have internal auditors, why do we even need to have internal auditors? Because external auditors come periodically, but the company needs more than just annual audits, right? Or half-year audits and so on and so forth. So that's where internal audit comes in. However, because these internal auditors are employees of the company, and they are, I mean, as employees, they are subject to the same rules, right? So some of the directors that these internal
Yes.
auditors will be looking at their work, the directors determine their salaries. The directors have the power to decide whether they are still employed or not, and so on and so forth. So it really becomes difficult to be independent and objective. So these two qualities becomes really difficult to achieve. However, these are some of the recommendations, right, that I personally believe could improve the situation. It might not make it perfect, but could improve the situation. My recommendation is, in a
Yeah.
company that can afford, the head of internal audit should be employed, or let's say should be recruited and should report to the audit committee, where there's an audit committee in place, such that that head of internal audit could feel some level of independence, because they will know, okay, you cannot get rid of me. I mean, directors cannot get rid of me without the okay of the audit committee. Also, the head of, like I said, reporting means when there are findings, the report should be addressed and presented to the audit committee. And then the audit committee, of course, is a subcommittee of the board. And then the board can now ensure that the recommendations of the internal auditor is respected, and this also gives the internal audit department some sort of independence. It's not perfect, like I mentioned, but it gives them some sort of independence. And again, if possible, companies should also actually consider outsourcing internal audit. These are practical recommendations, right? Rather than saying, okay, I will have an internal audit department within the company, and then I will only hire an external auditor. Some companies should actually consider hiring two firms, one firm for internal audit and one firm for external audit, depending on, I mean, and these two firms will have different scope, different work scopes based on the needs of the company. This recommendation actually ensures independence, right? But it also has a weakness, because again, if you're not an employee, because these guys are not employees of the company, they're not going to spend as much time in the company as an internal audit department will do. So it's really some sort of professional judgment based on the situation of the company. The board should determine what is appropriate. But what I'm trying to recommend here is there should be that effort to grant some level of independence to the internal committee, internal audit department. Sorry, otherwise the work of the internal audit team will not be very valuable, because they will lack independence, they will lack objectivity, and that has so many negative repercussions.
Okay, thank you, Mr. Aaron. I think that's a very brief explanation. Again, our audience here, Mr. Aaron has actually brought out two cases at the level of companies or big companies or SMEs or listed companies who can afford the role of an audit committee. Is recommending that to get best practice on corporate governance and to ensure the independence of the internal audit team. The internal audit team should be reporting to a chief internal auditor, who equally should report to an audit committee. Since in most cases the head of the audit committee is going to be a non-executive director, it means that if he reports at that level there, he will not face a lot of issues, because these are equally people who are not executive director. So if a company has enough resources, if it is a large company and the company is able to afford the role of having an audit committee, there are high possibilities that the company or that the internal audit department is going to be independent. But now let us look at a situation where we have startups or small and medium-sized enterprises, whereby they simply have an internal auditor. They simply have a staff who act as an internal audit without any head or without any chief internal auditor. There are high possibilities that that internal audit team member is just going to be window dressing, because In most circumstances, we always realize that they don't always end up adding any value. Why? Because of the fact that they are doing work, they are reviewing and reporting on work that they have been assigned to by the person who has actually employed them, which is the management, which is the executive management of the company. Thus, in this situation, we are recommending that, from my point, I'll be recommending that for a small and medium-sized enterprise of a startup to fully enjoy the benefits of an internal audit team, it is highly recommended that SMEs or startups should what? Outsource their internal audit team. Why? Because you should outsource your internal audit team, and you should equally ensure, assuming that you have 4 audits in a year, or maybe the quarterly audits, it means that you equally need to make sure that you rotate the audit team members which have been sent to you by the company that you have outsourced this activity to them. Maybe let's say after every year or after every 6 months. They should simply change those who are coming to conduct that internal audit team. The second step is that while you outsource that internal audit work to another company, the second step is that they should not report to the management of the company. They should report directly to the shareholders or to the owners of the company. And like we have explained, these are small companies, these are startups where they don't have a lot of resources to put in place all the committees that we have actually discussed here to ensure that they are adhering to best practice on corporate governance. So the best thing is that to ensure that the owners or the shareholders or and other stakeholders of the company are able to have an inside view and enjoy the benefits of a full independent internal audit team, they should outsource that internal audit activity, and at the same time that internal audit activity or the outsourcing firm should not report to the management of the company. I think we are saying this because of practical scenarios that we are faced in the corporate world. Because in the corporate world, if we assume that you outsource that internal audit activity to a third company, and that company still reports to the management of the company, again, we should equally recognize the fact that even the appointment of the appointment of the internal auditor that you want to outsource the activity should equally not be done by the management. It should be done by the shareholders. Again, we have said if now we look at the situation where they are appointed by the management of the company, it means that they equally will not be independent. Why? Because they have been appointed by the management of the company, and again, if they are reporting to them again, it means they'll also not be independent. So if we take an example where they're appointed by the management of the company, it means that they will always try to do whatever the management of the company wants them to do in order to maintain that assignment that have actually been awarded by that company. So for a small company or for a startup, an SME to fully enjoy the benefits of good corporate governance at the level of the internal audit team, they should outsource the internal audit activity. Again, the appointment of the outsourced firm should not be done by the management of the company, but by the shareholders or an independent external party. And thirdly, the outsourced firm should not report to the management. They should report directly to the shareholders of the company or to that third party that the shareholders have actually appointed. Because let's be practical, if internal audits come and carry out their work, they review the processes, they review all the operations of the company and identify certain issues that are going on. They will actually, first of all, report to the management of the company, the traditional view. The traditional view is that they're going to report to the management of the company to go through the report and make some adjustments. So the management, while going on the report, will realize that all these issues that are going on, or if there's any wrongdoing that have been going on within the company, for sure, this has been done by the management or by people that have been employed by them. In most cases, the management simply dictates what should be included in the internal audit report and what should not be included in the internal audit report. The internal auditors may have seen something which is going wrong, but because of the fact that the management of the company understands that if this is escalated to the shareholders of the company, they may take an action that will adversely affect them. You get it? So what would they do? They will simply instruct the internal auditor to remove certain points or to amend certain points. And again, like I've explained, assuming that we are following the traditional view, which is in the corporate world, where the internal auditors are appointed by the management of the company, it means that the internal auditor will be left at no option than to what? To adjust according to what management wants. Because they have been appointed by them, and at the same time they are reporting to them. So best practice to improve on the role of this internal audit team or internal audit department, especially for startups and SMEs, we are recommending that they should outsource the internal audit function. The outsourcing should not be done by the management. And again, lastly, the internal auditors which have been outsourced to do this work should not report to the management of the company. Mr. Aaron, I don't know whether you have any objection to what I've just said.
No, I 100% agree with you. I think you've broken things down quite clearly, and the recommendations are quite clear cut. So I hope that anyone who runs an SME, or any manager in a company, or someone who has a company and listening to us, they should be able to apply your recommendations, and they will enjoy the real benefits of having an internal audit department, because there is really no point in spending so much money, or and then not enjoying the benefits. So I think your recommendations are 100% agreed with from my side.
Okay. One other most important thing, which is the principles of good corporate governance, is performance appraisal or performance orientation. And I think this has a very, very important role to do with the traditional or the human resource function. With your exposure in the corporate world, having worked and now running a company, do you think that most the traditional appraisal systems that we have in the corporate world now are that all employees that are working with so many stakeholders, at the end of the year, the appraisal process is that the line manager of that employee automatically is the only one who actually decides on the fate of the performance of the employee throughout that financial year. Do you think this performance appraisal exercise, which has been practiced, which is currently being practiced in maybe 95 or 80 multinationals, do you think that it is time for the human resource function to evolve? And if they are going to evolve in this aspect of appraisal, what do you think needs to be done? Because to the best of my knowledge, an employee is dealing with team members, is dealing with a line manager, is dealing with a director, is dealing with external parties, maybe customers, vendors, with banks, and many other stakeholders. To the base of my assessment or judgment, using a single individual, which is not a 360 appraisal, to simply say, oh, this employee is doing well or is not doing well. To me, I think that the current appraisal system, which is used in appraising most employees in the corporate world within both multinational companies, is not fair. Because if we look at a situation where maybe the line manager, because of one reason or the other, is not in good terms with an employee, or let us look at a manager who is not, who cannot better appraise employees, it means that at the end of the day, employees dealing with 10 stakeholders within the company, 9 of them are very happy with this employee because doing a good job. But because of the fact that the employee's fate is in the hands of the line manager, he might end up giving what a bad rating to this employee. So I just want you to throw your light on this. We have few or 7 minutes to go. I think once you throw a light on this, we can now then open and we can now give the opportunity to our audience to ask any few questions. Over to you.
Yeah, so I will take this very quickly so that we can take some questions. So
Yeah.
I think the review approach, wherein the manager is the sole decision maker on whether an employee has performed well or not during the course of the year or during a reporting period, is unfair. Let's be very clear. And it's not a good corporate governance practice, because corporate governance, like we've said from the beginning of the session, is about fairness. And when you put the fate of an employee in the hands of one person, you simply build unfairness and bias into the process. You know, unfairness in the sense that the manager could negatively rate some good employees because of personal reasons, and then could inflate the performance of other employees again for personal reasons. That builds unfairness into the process. So you've actually touched on what I would recommend, a 360 approach, and this has to be customizable to the role. You know, some employees deal only with internal stakeholders, some employees deal with external stakeholders. So performance appraisal, I think, like you mentioned, the human resource function needs to evolve and maybe improve on this process. The performance appraisal of any employee should take into consideration the nature of their role and the nature of the stake and who are the stakeholders they interact with. So ideally, there should be some kind of input from the different stakeholder groups that the employee interacts with. So maybe peers, maybe input from the manager, input from external stakeholders like banks, like auditors, like the government, if the employee deals with the government and things like that. So that kind of approach, it's more of a balanced scorecard approach, let me put it that way, where you're getting every perspective and then you can make a more informed decision on the employee's performance. And that actually builds out unfairness into the process, because if the manager has maybe given a very bad recommendation or assessment of the employee's performance, and then the peers are rating the employee properly or much better, external stakeholders, then there is something wrong. Maybe there's some sort of disconnect or lack of transparency. Maybe the manager is not completely aware of the deliverables of the employee. There could be some disconnect in the process. It doesn't only have to be unfairness. There could be some disconnect, and without a 360 approach, this disconnect could end up affecting the employee negatively. And such an employee will feel unfairly treated, and they will actually just be looking for ways to exit. So I think I'll leave it at that so we can take some questions.
Okay. I think we are already at we are left with 3 minutes to the end of the session. So basically, to our audience, if you have any question, we call upon you to kindly give the questions, and then we're going to address the questions. Again, if you are a company who is actually facing a lot of difficulties, who is facing a lot of challenges on implementing principles of good corporate governance, or you realize that some of these principles that we have actually cited here in this conversation is not actually being applied in your company well, and you think that you simply want to implement principles of good corporate governance, you want your company, you want all stakeholders working with your company to be happy, not only the shareholders. You want to make sure that at the end of the day, your company is operating in a sustainable manner, because we understand that there are a lot of costs for a company that is not implementing the principles of what? Good corporate governance. Again, like we have said, we have very few minutes to the end of the session. So basically, you can normally email us, or you can just go to Decalo Consulting, Decalo Consulting or decalo.com and book a session with us if you want to have a further discussion on this topic. So let us wait whether we are going, any questions that we're going to receive here, we're going to attend to our audience. So in the meantime, we are still looking at whether we can have any question. So let us just be looking at any questions. So far, we don't have any question, and we have 2 minutes to the end of the session. Mr. Aaron, you have anything again to say?
No, I think it's been a very insightful discussion, and like I mentioned, it's always a pleasure to be on this platform. I always enjoy the quality of the conversation, So I'm happy we had this session, and please do not hesitate to invite me in the future, for quality discussions like this. It helps to refresh me as well, and it reminds me, like this conversation has actually reminded me also on the importance of applying good corporate governance practices within Switcher. I mean, we try to do that, but again, it's an ongoing process. It's not, there's no perfect structure. We have to keep adapting. So I'm really happy that we had this conversation, and I've taken one or two lessons that I will now implement in my
Okay,
company as
thank you
well.
so much. And again, like we've said, it was a pleasure. We thank and appreciate everybody who was part of this session. But because of the fact that we have a time constraint, we will not be able to fully discuss on the corporate importance of the principles of good corporate governance to an organization, as well as look at some of the best practices. And as a result, we thank you once more and hoping to see you or to invite you attend other future sessions with us. Once more, thank the team at the Gallo Consulting Group for bringing I and Mr. Aaron to this good session today. If you have any questions, please always info them to the Digalo Consulting Group at consulting@digalo.com, and we're going to attend to you. Have a good day, Mr. Aaron. Thank everybody for attending this session. Have a nice weekend. Bye.